Good afternoon, everybody. My name is David Marsh. I'm the chairman of OMFIF, and it's my great pleasure to introduce this final session of our payments conference today. We thought we would go out on a bit of a limb here and bring in another really live topic into this subject, which is the gold market. The reason why we did that is because over the years we've discovered that there are correlations when there are changes in the world monetary system and the nature of money, that this tends to have some implications for the precious metal of gold. And so we have put together a report which Shokai Fan, who's the head of central banking at the World Gold Council, will be speaking about. And we also have Marius Georgilas, who's a member of the board of the Bank of Lithuania, in charge of asset management, research, but also into payments, and has made a big study of this issue, also having worked in the past at the Norges Bank, the Bank of England, and the European Central Bank. He will be commenting on this as well. Shokai, I might add, has also been working for the US Treasury, which of course is the biggest owner of official gold in the world and remains that way. So this report is available now for everybody to have a look at through our website. It's just been put out today. Shokai, it might seem a strange thing to do, to try to link together the whole question of central bank digital currencies, both retail and wholesale, and gold. But of course, this digital area does imply and may bring a certain amount of disruption. And gold, we all know about the gold market and the disruption of the international monetary system. Sometimes the disruption or upheavals in international money have had a big impact on gold. So perhaps you could just talk us through the report. Also, those of you who are listening, please do put in questions at any time in the chat function, and we will put them to the speakers, and we will try to develop answers to those ourselves. So let's have a proper dialogue through the chat function. But Shokai, very good that you're here for the World Gold Council. Over to you to give us some of the highlights of what this report actually says.
Thank you so much, David, and thank you to OMFIF for inviting me for this fantastic event. Good afternoon, everybody. Good morning from New York. I'm really excited to be here to talk about this new report that OMFIF has graciously put together in coordination with us, the World Gold Council. Just in case the people on the line are not entirely aware of who we are, the World Gold Council is a nonprofit market development organization for the gold industry. We have a general mandate to improve and enhance the gold market, and I lead our efforts with central banks around the world, guiding them on how to deploy and use their gold reserves, and any other questions they might have about gold. But I think, David, you set the stage really well in sort of talking about the symmetry between the evolution of the international monetary system, the evolution of money itself, and gold. I think if you look at the history of money, it really is a long story of slow creeping technological change impacting how money is used. Of course, the earliest form of, we can't quite call it money, but the earliest form of transaction was the barter system. But the barter system could only really be supplanted with precious metal money, with commodity money, once things like refining and coining technology were improved to a point where people had trust in precious metal coinage. And of course, the rise of paper money, of notes, that could only be fully acceptable once we had printing technology that was able to ensure that counterfeiting would be difficult, that notes would be widely acceptable. And I think only when we reach that point could paper money really supplant commodity money as the primary source of payments. Now, of course, we're on the cusp of potentially a bold new age in money. With the evolution of digital technology, it's really interesting to see new forms of payment, new ideas about what the very nature of money is. But, all throughout the evolution of money, gold has been there all along. Its role has changed over time, but it has still been there. So it is really interesting to use this report as an opportunity to explore how potential changes in the nature of money might impact the gold market going forward. So again, kudos to the team at OMFIF for putting together such a wonderful report. I'll just go over some of what I think are the key highlights of this report, but I do encourage everybody on the line to download it when they have time and to give it a very thorough read because it's an interesting topic. Of course, the report starts off by talking about where we are in terms of CBDC development around the world, what various central banks are contemplating, different predominant models for CBDCs. But I think the heart of this report is exploring the potential implications of CBDCs and the gold market. And I think there are three main areas where CBDC development might impact the gold market. The first is the programmability element of CBDCs. Now, this is very interesting, of course. Programmability has a very wide range of what a central bank might be able to do, from being able to impose expiration dates on money to maybe limiting how you can spend money on certain maybe items that they don't want you to spend on, fatty foods, alcohol, tobacco, for instance. These are all possibilities that are enabled with programmability. I'm not saying that that's what's going to happen with CBDCs, but they're all interesting possibilities. But another possibility, of course, is the ability to deploy helicopter money, which might be very useful in current times when you want to roll out stimulus to as many people as possible. But I think these issues might make people think about the prospect of inflation, whether it's with the prospect of helicopter money and being able to just roll out vast sums of stimulus, or with expiring money, for instance, which is essentially just another way for a central bank to encourage people to spend, somewhat like a negative interest rate. And we know that gold has had a long history of being both an inflation hedge and also has a strong relationship with rates, with real rates, of course. And if there are signs that there might be potential inflation on the horizon because of CBDCs, I think that will maybe prompt some people to think about, are there other ways for me to store the value of my earnings, my savings? And I think gold might be one of those ways that people can do that. Now, these are all speculative possibilities for CBDCs, of course. I think throughout my entire presentation today, you might hear me use the word speculative a lot because we just don't know how CBDCs will evolve. But that is one possibility in terms of their evolution and the impact on the gold market. Another area where I think there might be some linkages is cashlessness, or maybe the loss of anonymity or privacy issues. That's another interesting aspect of CBDCs. If we're moving into a world where a central bank will be able to know exactly how you spend your money, I think that will raise some concerns about anonymity and privacy within certain segments of society. And that might have some spillover effects into maybe prompting people to consider other forms of financial assets that provide a little bit more anonymity. It might have some benefits for gold, but again, speculative. We don't know exactly what the future of CBDCs will be. But another, I guess, more direct impact is maybe the limits on purchasing, because there have been proposed ideas about maybe limits on the amount that CBDCs might be. And there have been some recent examples in the past of when limits have been placed on buying certain items. There have been spillovers into the gold market, sometimes positive, sometimes negative. So again, that's another interesting corridor where I think there might be some interaction between CBDCs and gold. The last thing I'll bring up in terms of how CBDCs might impact with the gold market is the rise of cross-border flows. CBDCs will reduce the transaction costs for FX. Presumably, they'll make it easier to buy things across borders. And although I think that if CBDCs stay purely in the realm of just being a payments technology, enabling people to buy things more easily, that might not have a specific impact on the gold market. But if they grow to a larger scale, then it will really reduce the risks and the frictions involved in the FX market, which might induce more risk-taking behavior, might induce more speculative FX flows. And I think that will make some central banks think about boosting their foreign exchange reserves as a result. And that might have implications for gold as a component of foreign exchange reserves. Of course, this is the area of the gold market that I deal with the most, gold as a reserve asset. So I think it will prompt some central banks to think about how do we curb this speculative activity better? How do we ensure that our reserve portfolios have adequate protection? And in recent times, we've seen that central banks have been turning to gold as a way to hedge against downside risks. In our most recent central bank survey, for instance, we found that gold's performance during times of crisis has now risen to be the #1 reason for central banks to hold gold. The first time we've seen that happen in the 4 or 5 years since we've been doing this survey. Certainly, what we've experienced with the pandemic might have changed some central bankers' minds about downside protection, but I think that it does demonstrate the value of gold as a hedge or as a safe haven asset in a reserve portfolio. And if CBDCs grow to an extent, if they evolve to the point where they start to create more speculative flows in the FX market, then I think that might prompt some central banks to think about reserve management activities as well. Ultimately, I think these three aspects are all possibilities, all speculative possibilities. It's not entirely clear what the future path of CBDCs might be. There are many different models that are being explored out there. And we don't know which one's going to prevail. There might be many different ones that will prevail. But I do think that there will be some impact on the gold market, whether it's talking about inflation, whether it's talking about expiring money and wanting to therefore transfer your savings into something that will be a little bit more durable, whether it's in the realm of privacy and anonymity and cashlessness, for instance, making people reevaluate the relationship between them, their money, and the state, or whether it's in talking about cross-border flows and maybe building up more speculative positions in the FX markets and the need for gold to therefore play a bigger role in reserve assets, as we've seen with other disruptive events in very recent history. So, I think I'll leave it there in terms of the main findings of the report. I'd be really happy to hear about any questions that people might have, but I'll hand it back to David. Thank you.
No, thank you, Shokai. As you say, it can go in both directions, and you could construct a case for CBDCs leading to a more stable system, which could then mean that countries might be economizing on their foreign exchange reserves, in which case they might decide they'd lower the amount of gold. So, as you say, it can go in several different directions. I'm really struck by this issue about privacy and anonymity. It's something I'd like to bring on with you, Marius, because I believe there is a correlation. I'm not sure whether it's really come out in this report. The countries which are quite keen on bringing in CBDCs, either wholesale or retail, are those who sometimes may be somewhat distrustful of the dollar, and also whose citizens don't actually mind handing over quite a bit of power to a central bank. In the European Union, Marius, I don't think we do have that issue. You are obviously part of the European Union, and Lithuania is part of Economic and Monetary Union. Could you just bring us up to date with where we are in terms of where the ECB is? It's still studying this question, isn't it? And thinking about various pilot projects. And also in Lithuania, would there be amongst the population a widespread antipathy to somehow handing over your data to the central bank? People talk about financial inclusion, but sometimes they don't actually want to include the state, the government, in this big inclusive system. So from a more philosophical point of view, could you just give us a bit of a state of play, and how does that relate to what Shokai has just been saying, Marius?
Thank you, David. Well done, Shokai. So first of all, thank you for having me. Really interesting spin on a very hot topic on central bank digital currencies. And I really encourage the audience to give it a try and read the report, which is not like the usual ones you have seen around. And having said that, and really well done, Shakaya and the team who contributed to this report, because I really found it honest in a sense that it's not saying the things that we don't know yet with certainty. And yes, the word speculative actually is used very, very much in the report itself, in a good sense, because it's trying to figure out the impact of central bank digital currency on on commodity market, that being gold, and actually provide implications to foreign asset managers. So I really found it very interesting. And back to your question, David, on privacy and the state of affairs on that. First of all, I'll say my personal opinion on this. We don't know. And I think that's the fair answer to this. And let me substantiate this. Have we asked the citizens and the broader public on their preferences? We did. Do we have the numbers? Yes. Do I believe them? No. One thing is to ask the people, to ask the person, does he like the environment, and does he think that pollution is bad? Is one thing. And the second thing is to see him drive a big SUV with no regret.
Could I just ask you, please, Marius, just when you say we have asked the public about this issue, do you mean in Lithuania, do you mean the Baltic states, or do you mean the EU as a whole?
So European Central Bank has consulted the public, and we issued a consultative paper on the potential digital euro, and what would be the most worrying or issues that people would put forward, and privacy and ability to control the information that accompanies any payment is on the top of the agenda of the people that have responded. The interactiveness of the general public in this subject, I believe, is still very low. It's very difficult to explain to the general public what digital currency is and how exactly it will be implemented. We have good examples, or potential examples in other countries, and we already see some alarming implications. Although the most important risk vectors that central bankers see are coming from the types of financial stability implications, potential monetary policy transmission mechanism disruptions, it seems that another list of issues that we have to make sure we address is that if CBDC is not perceived to resolve some specific issue at the wholesale level, at the retail level, people do not use it. And it seems that the low take-up of usability of the trials in digital yuan in other countries is sending a signal.
If I could
I don't think that is related to privacy. It's about understanding the benefits.
If I could just ask you one more thing before going back to Shakai on this question of public acceptance. Also, may I remind people there is a poll as well that we have got on the separate screen that you can see, asking you whether you think that there will be more or less or the same interaction between the gold community and the CBDC community. So may I simply remind you, please, those of you who are listening, to look at that. But just going back to this issue about privacy and so on, OMFIF has done a study on this, which we actually reference in the report, which was amongst a number of developing and developed countries. And it showed that in a country like Germany, there's still very widespread antipathy regarding a central bank digital currency on account of the privacy issue, on account of German history, frankly. Is that the same basic finding that you found when you were polling people in Lithuania? And also, of course, the payment system, the existing electronic payment system does work, doesn't it, in Europe extremely impressively. So that issue that you made, could you just add a bit of extra color on that, please?
Yes, of course. So it's, I believe, a very well-known fact that certain countries in Europe, they love cash. And a self-respecting German does not leave his house and doesn't go for a beer if he doesn't have 100 euros in the pocket in cash. But that is not equally the same issue across the European Union, and Nordic countries are resolving a completely different issue, which is cashless society, and what would happen if the legal tender, which is physical and physical notes, are not circulating wide enough, and how does that affect all the other issues in the society? So I would say that this issue of love of privacy, love of cash, and disliking of digital payments is a very balanced one on both ends of the spectrum. And that's the reason why different implementations, potential implementations of central bank digital currency are potentially addressing different issues. Financial inclusion on one side, cashless society on the other side, privacy, preserving privacy, addressing the issues of potentially illicit activity, and finding the balance between those multifaceted issues that currency tries to address. Because money is not only an asset, it's an infrastructure. And in preparation for this call, we discussed that you can look at CBDC as yet another technology or digital reincarnation of the same currency as we know it, or it's just a better infrastructure which allows us to address all these issues and find better balance between those various
But it's also
dimensions.
it's also potentially handing over the keys of a very important door to a different set of players, isn't it? And Shokai, one of the points about destabilization is that if a central bank digital currency at a retail level were to be introduced, let's say in Europe, it could have a very powerful destabilizing effect on the banks. And that, of course, could therefore have a knock-on effect on the gold market. But I would have thought that it's unlikely that Europe will move very quickly in this direction, precisely because it could really knock the profits of the European banking system. So could you perhaps put those different issues together, please, Shokai?
Sure. No, I agree with you. I think that central banks who are developing CBDCs, I don't think many of them want to supplant the role of existing commercial banks. And I will add on to Marius's point about Germany specifically and the German love for cash. I remember landing at Frankfurt Airport once, only for a 2-day visit, and the immigration officer asked me how much cash I had on hand. And I said 100 euros. He said, "That's it?" I said, well, yeah, I have a credit card. You know, it's not like I'm going to be cut off. But it does really emphasize or underscore the German love for cash. And I think you're right. You know, in Europe, there are different cultural and historical reasons for liking or disliking cash, and therefore also liking gold as well. I think it's also very much symmetrical. The love for cash in Germany is symmetrical with the love for gold in Germany. Germany has one of the highest per capita gold owning rates in the world at the retail level, at the individual level. Of course, that has a lot to do with German history and the hyperinflation during the Weimar Republic. But there was a time when I think Germany lowered the ceiling for how much people could buy in gold anonymously, from 10,000 euros down, I think, to 1,500 euros. And when they announced that change, it prompted huge lines at gold dealers throughout Germany for people to line up and buy gold before the limit changed, because they want to be able to save money privately, anonymously, and they don't want to have to declare every time they buy some amount of gold. And I think that speaks a bit to the German psyche as well, the love for cash, the love for anonymity, wanting to have an inflation hedge as well. So you're right, David. I think that there's going to be some implications of CBDCs in Europe. It might be different country to country for different cultural and historical reasons. But like I said at the top, the underlying theme of today's discussion might be speculative, because we just don't know what's going to happen at this point.
Yeah, and of course in Europe, Marius, it is one size fits all. You can't move at a different pace when it comes to Lithuania vis-a-vis, say, France or Germany or Spain or Italy. But could we just go back into this issue about credibility? Because we mentioned the word inflation here once or twice. We now do have inflation at above 4% in the euro area, partly for special reasons, base effects and so on, the spike in the energy prices and so on. But a lot of people do actually feel that this is going to be now structural inflation. I'm not going to ask you to get into this big, powerful issue and possibly cross swords with Madame Lagarde. I'm not going to ask you to do that. But the point is, if there is worry in the system, whether in Europe or elsewhere, about the basic structure of money, then you might imagine that A, there'll be more interest in gold for the reasons Shokai has been mentioning, and B, they might be more interested in other sorts of more exotic or newer forms of currency systems. And if I understand it rightly, the reason why central banks started looking at CBDCs, they were worried about the private sector moving in and taking away a monopoly that the central banks had for 200 years. So could you comment on that set of correlations, please?
Me, David, or Marius?
No, Marius this time, please.
I thought I'll get out of this. So Shokai, if you want to take it first, then be my guest.
No, I'm asking. I'm putting you on the spot, Marius. There is an issue of credibility and trust, isn't there?
Is there an issue of credibility? People still use euro, US dollars, yen on a daily basis. Is there an issue of credibility in that? I don't think so. What is happening is activity on the edges of a society, and potential that a better technology in the hands of the private sector can produce an outcome which can be perceived as better service of trust that central bankers are providing right now. Actually, I think it's a good outcome. It pushes central bankers to be, hot-seated and to think, can we also provide what we are doing in a more efficient fashion? And just referring to the facts provided in the report by Shakaya, cross-border still is not resolved issue, and the cost of transactions and in the cross-border space is still not what it could be. And various trials in cross-border central bank digital currency space show that efficiencies can be achieved. So I guess there is space, and I don't think it's an issue of trust. It's an issue of can we do it better? And yes, society is challenging us.
I think that's a valid point, and it's difficult to comment on things like this, which are slightly ethereal issues at the moment.
No, I don't think it's ethereal, right? Let's take the most difficult question that I tried to avoid, but okay,
yes,
fine.
We're getting into it now.
Inflation, right? Here comes a private sector, big technology company, and says, look, I'll resolve an issue of cross-border payments by providing digital wallets, and these wallets will be populated by stablecoins. But the feature that the rate at which they lose value will be programmed in the code itself, whatever the society likes, or whatever we decide to, and we'll just lock it and throw the key out, be it at 0, be it at 2%. Doesn't that sound like a central bank controlling inflation? Yes, it does. Can it be implemented? It might, and that's interesting. So
yes, well, I think this all this shows that this is really a hot subject. I think that we've stumbled into here. I've got a lot of really interesting questions coming in now from the audience. Also, I've been given a bit of an update on our poll. We're just going to give the audience another 5 minutes to answer the poll, and then I'll announce the results, which I don't think are going to really surprise anybody, but I will announce the results anyway in 5 minutes. Shokai, a really good question here from Vidilio Mendoza from Northern Trust, and this plays to your strengths because you were very much looking at the renminbi in part of your role previously. So the questioner says, could a central bank or government in theory give an economic partner central bank its CBDC in payments as part of a swap agreement, like the PBOC might have done in the past by giving partner central banks renminbi? And then what might these central banks do with this digital yuan, for example? So this is really piling speculative question upon speculative question, but this is what this last panel is really here for. So how would you answer that extremely good and almost unanswerable question?
I think it's entirely possible that, through a swap line, the PBOC might extend a digital RMB to their swap counterparty. The question is, what is the difference between a digital RMB and regular RMB, especially when it's outside of China and you can't spend it per se? If we're talking about the programmable elements of CBDCs, then that programmability is really only germane in the country where you can spend it. If you're holding a vast sum of RMB CBDC offshore, for instance, I'm not exactly sure how that would be different than holding regular RMB offshore. You use it to be able to get liquidity, for instance. Maybe it's faster to transact. There might be some elements of that, but I think it's too early to say how you can use another country CBDC when it's not inside that country and you can't spend it.
I think Marius has got a point, but I would have thought that a digital currency, yuan, outside the country, the central bank, the PBOC, would have more power over that, I would have thought, than it might over a freely floating, circulating yuan, which represented an asset or a liability position on private banks. So that might be one reason for this. But Marius, you've got a point on this, I know.
Yes, I do. So when the Bank of Lithuania opens an account if it would open an account at the PBOC, we would hold digital yuan. Let's not call it central bank digital currency, but it's a liability of PBOC towards Bank of Lithuania. So can it happen? Yes, it's already happening. But it's again the same issue that you, David, asked us about. It's the issue of trust. Let's say these are either digital tokens or just account-based tokens that central bank of a different current country holds with regard to another country. Do I trust that the infrastructure or the legal regime that has issued these tokens, units of account, will deliver or will not implement some programmability elements in the currency that I hold, which will put me at a disadvantage in one or the other sense, limit the convertibility of my holdings, implement some capital flow rules, which is the issue that we face right now. And that's the reason why we have various currency areas, and that's why we have capital controls in some of the countries. And there is no way to go through that boundary if a certain regulator of the government wants to have it. And that issue will still remain in the CBDC world.
Yeah, well, certainly, and I would have thought the programmability that Shokai has been talking about, if you applied programmability to a swap, it would mean that the borrower, the taker of the currency, would have absolutely no option at all about whether to repay, because that swap would simply expire. There would be no money any longer at the end of the 3 months, because there have been problems in the past when the swaps have not been unraveled for various reasons, have not been unwound. Can I put you another difficult question here, Mario, since you are specializing in the difficult questions today? This is from Bruno Schneider-Lesaut, who's the chair of the European Blockchain Federation. He's going back to this issue about privacy and anonymity, and he's talking about the governance of a future CBDC in Europe. He's not specifying whether it's retail or wholesale, but I presume this would apply more for retail. And he's saying, how would the European Commission and particularly the independence of the European Central Bank, how would that impinge on this privacy issue, which is very germane to many people in the European Union? It's a slightly general and open-ended question, but you can see what he means. The central bank is independent, and therefore should it take account of issues like people's desire to have privacy and anonymity?
I guess it's me, right?
Yes, please.
I'm not a lawyer, but there are legal issues which are not resolved with certainty yet. Is digital euro a euro which is specified in the founding articles of what European Union and what Eurozone currency area is? It's not settled issue yet. The mandate to issue euro is conveyed upon a European Central Bank. But is that the same thing as digital euro? We are having consultations, let's put it mildly, with various legislators across the European ecosystem to ensure that all various legal aspects are resolved, because sometimes we have not only different views, we have conflicting views, like we have even with monetary policy and quantitative easing. Is that the thing that European Central Bank can engage in? European Constitutional Court has a view, European Court of Justice has an opposing view, and we have to settle those views. So the question that a gentleman from the blockchain institution is asking is much more deeper than it sounds at the face of it.
Well, I think, again, this simply opens the path for more conversations. I've got a question for you, Shokai, in a moment, but let me just simply announce the result of this poll. I think it's pretty obvious what the result would be, but people were asked, do they think that over the next 3 years, interaction between the CBDC and the gold community will stay the same, reduce, or increase? So 24% say stay the same, 12% say reduce, 65% saying increase. I mean, I presume at the moment there's only a relatively low level of interaction. So I think it's any person would probably have concluded it's more likely to increase than reduce. But we'll have to see how this actually works and whether our meager efforts here have made any difference to this in the next 3 years. We shall see. It's a good question here now, going back to the economics of all this. And then there's also some questions coming in about the cross-border aspect. This is a more basic question for you, Shokai. And also, I could bring in Pierre Otley from OMFIV, who is the main author of this report, who is somewhere on the line. He might want to have a go at answering this question as well, because I know it's something he's thought about. But this is Francis Reis, who's Communication and Content Marketing Manager at SICPA. And Francis asks, how will central banks manage the supply of retail physical cash versus CBDCs? There's a question for you, Shokai, but Marius, you may have a view as well. Will the central bank increase the overall amount of legal tender in circulation, or will there be a split based on current levels of M0 in a country, i.e. 5% of the total and no more, for example, because it could be potentially inflationary, clearly, if you did actually increase the overall amount of legal tender while you were experimenting. What is your view on this, Shokai? And Pierre, if you're listening in and you'd like to have a go at answering this, you can as well. But also, Marius, it's a fairly basic question. Shokai, over to you.
Thank you. That's quite an interesting question, actually. I hadn't thought about that deeply before, but I would guess that if the central bank is going to issue CBDCs, they would want to not have as much paper money in circulation. I know that for some central banks, part of the rationale for contemplating a CBDC to begin with is to reduce the cost of creating and maintaining paper money, especially for central banks that have maybe very sparsely populated communities in certain parts of the country where they need to really make a lot of extra effort to ensure there's enough cash circulating in those communities. I would think off the top of my head that they would have less paper money in circulation. Is that the question?
Yeah, that is very much the question. But whether this will be pro rata, that's the issue, I think, or whether you'd leave a bit of oversupply of paper money. I mean, you might say it depends on demand. It doesn't depend on supply. Yeah. It might simply demand it might be the public that is simply there to ask. I mean, Marius, do you have a view on that?
I think it's a very simple answer. Let's rely on what we know, because we know quite a lot on cash currency, and that's driven by a complete demand. So as much as there is a demand for cash from the commercial banks, we stand ready to provide, and not only to provide, but to provide in various denominations. And if I understood correctly, the question it's also answerable. Would that have any impact on the high-powered level of money, be it M0 or M1? No, because the way we are contemplating how digital euro would appear, it's by converting other holdings of your reserves into either digital euro or physical notes or coins, which is happening right now one-to-one at the one-to-one convertibility. What might be more subtle is if, and I haven't seen that anywhere, if commercial bank money could be convertible into digital euro, but that would be already converting commercial bank money into reserves, and that's a bit of a misnomer to me.
Well, presumably, Marius, this has got big implications for the money market, doesn't it? Because if, let's say, retail and wholesale deposits at commercial banks are going to diminish, because people will have the option of having a digital currency issued by the central bank, that's going to deprive the money market of a lot of liquidity. It could drive the money market out of business altogether. It could mean that money markets rates will go up. Marius, is that something that you've thought through, this structural impact? It's a part of the question regarding the health of the banking system, but it's a particular thought about the money market, that we might have to accept a higher rate, a higher level of money market rates if there were to be this substitutability at the wholesale level. Have you discussed that, Marius, with your counterparts?
Of course, this is an issue that central banking community, not only at the European Central Bank, is very well aware of, and that's the reason why the design of central bank digital currency, and in our case, digital euro, must ensure that the functionality of digital euro as a payment instrument is good enough, but it's not being used as a preferred asset to hold your value, because we do not want to disrupt the banking system as we have it, which is functioning to a broader extent quite well. And the issue that you're raising will not be an issue if people only view it as a payment instrument, which resolves the inefficiencies that we addressed at the beginning of our conversation. Do I believe that digital currency would be the preferred asset where to hold your wealth, your foreign reserves? I don't think so. We are in the world of negative interest rates right now, and we do not. Yes, we see increase in cash holdings and other, very highly liquid assets, but it's not going through the roof as the theory would predict.
No, that's right.
Well, why is that the case? Because of frictions, and the frictions are the usual ones: transaction costs and other elements.
Well, that brings us on to a question actually from one of the listeners, Nicholas Timostokli. And this is a question for you, Shokai. It's about negative interest rates, which are, after all, in Europe have been negative now for 5 or 6 years and likely to remain that way for some time. So Nicola asks, central banks need to invest in something, and there may be limits on the degree to which they want to invest in the dollar. We've seen this, haven't we, in certain countries such as Russia, such as China, and a number of other countries as well. Even countries like Poland, that are actually very friendly to the United States, have been increasing their gold reserves. So the questioner says gold will remain, he thinks, capped. I mean, he says 20%. It's obviously varies, isn't it? It's highly variable. Some countries it's 2%, some countries it's 65%. But let's take an average, say, of 20%. It's probably more like 10%. The questioner says, where else do you think central banks will invest their reserves? That is assuming central banks maintain or maybe even slightly increase their reserves. What is your feeling there, Shokai? In the last few years, we've obviously seen a number of what we might call the more fringe currencies increase in attractiveness. But what would your guess be for the next 5 years?
You're right about the fringe currencies, the Canadian dollar, some of the Scandinavian currencies gaining traction as reserve assets. The RMB, of course, but a lot of that question will lie on future convertibility, openness of the capital account, and obviously geopolitics with China as well. I don't think there's going to be a cap on gold as a proportion of reserve assets. I think every country is going to have to make, every central bank is going to have to make its own decision about what the right asset allocation will be. And for 11, 12 years now, we've actually seen central banks be net buyers of gold as a reserve asset ever since the financial crisis. And I don't think that trend is going to necessarily stop. In fact, just this year, we've actually seen quite healthy central bank reserve buying from the Bank of Thailand, the central banks of Hungary, Brazil, and India as well. And I think the emerging market central banks will continue to be the main driver of gold accumulation as a reserve asset. So I think gold will still be a beneficiary of central banks wanting to move away from low or negative yielding currencies. I think also, moving into equities, other non-traditional asset classes, that's been a recurring theme for a few years now in the official sector. And I think there's been more interest in some central banks to look at equity mandates, or at least dip their toes into the waters of the equity markets, try it out for a little bit. And then also, it wouldn't be a financial discussion without ESG being brought up. There has been a lot of interest into ESG related assets among central banks as well. That's not necessarily a result of the interest rate environment, of course. It's much more of a policy decision. But I think that we'll see growing allocations to ESG assets as well among central banks.
Okay, well, I don't want this to drift off into a question and answer session or something a bit outside the core topic, but you might well have some views on this, Marius. You've made the point that gold makes up 8.3% of the total reserves at the moment, so a little bit less than 10%. What would be your answer to the question that the audience member put?
What would be the change?
And who would benefit?
I really don't think that structurally introduction of central bank digital currency can have an effect on the willingness of reserve manager to hold gold in his portfolio, because we don't know the answers so far. What would be the effect of cross-border usability, for example, of US dollar? Would that make it easier for Chinese public to hold US dollars, or that would become more difficult? Because the question, should we allow, because it's a question of policy, should we allow non-citizens to hold digital currency? It has not been answered yet. And depending on the answer, which is again a policy issue, if you do allow, then all of a sudden it becomes easier, because it's not, if you are outside of US and you want to hold US dollars, you have to do it in physical form, unless your bank provides a US dollar account, which is becoming a very rare instance these days.
David, I'll add another wrinkle onto that. I think it's also on the dollarized economies in Latin America, for instance. What's going to happen to them if the US dollar becomes has a digital variant as well? Is it going to be easier for them to continue having a dollarized economy, or harder? We don't know, actually. So that'll be an interesting implication as well that we need to think about.
Well, I want to get onto this cross-border aspect, which we brought up earlier as a seminal part of the report, and you alluded to this, Shakai. You said that, for example, if the system did turn out to be an area where digitalized currencies were able to move around more freely, there could be more speculative forces between, say, neighboring countries. One thinks, for example, of Southeast Asia, which is where you normally reside in Singapore, where there's a lot of fungibility and a lot of interoperability between individual capital markets that could therefore lead individual countries to want to hold more currencies in their reserves to guard against this. Or it might lead to capital controls or other forms of protection. Or it could actually, if you have a more efficient cross-border payment system, it could actually mean that, as I said myself earlier, that countries might want to economize on reserves, because you wouldn't actually need so much of a buffer, for instance, for when your families, if they were receiving their payments on time, say in the Philippines, and didn't have to pay 5 or 6% in transaction fees to the banks, that could actually mean that the whole current account position of the country might actually be improved. So could you just add a bit of depth to this issue about the cross-border aspect of CBDCs? We are going to see that. I think it's absolutely sure that in Southeast Asia, we will see interoperable wholesale CBDCs being introduced. So would you like to stick your neck out and say what effect do you think that will have on the reserve managers?
Absolutely. I think you've already painted all the different scenarios that might be. And especially in a place like Southeast Asia, where you have a lot of cross-border remittances, and also the rise of multi-currency CBDCs. We've seen this, new agreements come out in Southeast Asia between different central banks to collaborate on CBDCs. I think there will be some impact on reserve management. But first and foremost, the CBDCs will make life much easier for the hundreds of thousands, if not millions, of migrant workers, domestic workers, cross-border workers in the case of Singapore, where we have, in normal times at least, hundreds of thousands of people coming over from Malaysia to do day labor in Singapore. It will make their remittances much easier. And I think that's overall a very, very good thing. But, I think that if CBDCs grow to a point where they're not just used for remittances, but they're used to really reduce frictions and allow people to take much more speculative positions in FX, really increase risk tolerance, either at the individual or at the institutional level, then that will have to prompt central banks to think about FX volatility a lot more and lead to them to either increase their reserves or think about the allocation of the various reserve assets to protect against downturns. And of course, gold has historically provided a lot of protection against major financial downturns. We have a famous chart we use in the World Gold Council that shows gold's performance throughout every financial crisis since since the 80s, actually. So, and it does provide downside protection for reserve assets during that time. So I think that, if we move down that road with CBDCs and there is more FX volatility as a result, then we'll see greater reserve growth and then greater demand for gold as a reserve asset.
What would you say to that, Marius, just from a purely economic strategy, analytical point of view, leaving aside the fact that you work for the Bank of Lithuania? How do you find the economics in what Shukai says? Do you find those stacking up? Do you find that credible, what he's just said?
I will not put Shukai on the spot by providing the comment. Does it make sense or not? It's a view, and economy operates on views. If it would be just one-sided view, the asset class would collapse or the price would go through the roof. And diversity of views is not either wrong or right. It's because we don't know. And from economic perspective, we have no idea what the shocks would be and how the shocks will play out, not only in particular sector in the economy, but how do they propagate across different economies and different countries. And if we are synchronized or not, if we are synchronized, if the world would be completely synchronized from a risk perspective, one currency would suffice. The Earth would be just operating under one optimal currency area from an economic perspective. But we know
there were these ideas. There was this idea in the 1850s, wasn't there, to have a single universal currency? This was the.
So let's go back to the subject of our discussion. Let's tokenize gold and use it as a cross-border payment instrument and store of value. Is that good enough? Is that the answer? We know, well, from macroeconomic perspective, we know that's not efficient because there are reasons why you need to have a higher or more loose monetary policy stance in one corner of the world compared to the other. And how you do that, you need to have an instrument, and that instrument is the ultimate settlement asset that we are debating right now.
Yeah, well, of course, the interesting thing about gold is the distribution of gold reserves. And really, because of history, the 1950s and the 1960s, you have a big skewing in the direction of the advanced countries. And of course, with the United States, I mentioned earlier, the US Treasury. And since 1971, of course, the US gold stock has stayed the same. And even though some central banks in Europe did sell some gold 20 years ago, they certainly haven't been doing it lately. And so one has the impression, therefore, that the central banks in Europe, partly as a hedge to things like Target 2 in the European payments infrastructure, they feel that it's a good thing also vis-a-vis their populations to hold on to gold. I mean, gold has become much more popular in the eyes of the individual reader of newspapers in terms of central bank gold than it was, say, 20 years ago, when the Bundesbank moved a lot of gold from the vaults of the Bank of England back to Frankfurt about 15 years ago. They didn't tell anybody, and it was a complete secret. These days, when they move gold, they make films about it at the Bundesbank because they want to show the people the gold is safe. It's back with us under the building of Frankfurt. So it has been a big difference here. I just want to get on in the final few minutes into this issue about regime change. Funnily enough, this came up this morning. A well-known economist in Germany, Hans-Werner Sinn, who can always be relied upon for a juicy quote on almost any issue. He's talking about a regime change towards more inflation. But let's leave that to one side because, as Marius might say, nobody knows the answer to that. But Shukai, various bits of research that OMFIF has done with the World Gold Council over the years, very empirical, do seem to show that when there is either regime change or a hint of regime change in the world monetary system, gold does tend empirically to benefit. And we did this study a few years ago about the renminbi. And of course, we also found that gold is a very good hedge, not just against inflation, but against deflation. I seem to remember the 1880s being a case here. Do you think it's wise or appropriate to talk about, quotes, regime change in the world financial and economic system, Shokai?
Well, I think that the international monetary system is continually evolving. Luckily, hopefully, we're not going to have another episode like the last time we had to have a regime change, which was the result of a world war, of course. That any future changes to the international monetary system will be gradual and will reflect the natural economic dispersion of power in the world. You're right. We did collaborate on that paper a few years ago, which I encourage everyone to read as well, on how gold has performed during periods of change in the international monetary system. And we think that gold, generally speaking, does perform quite well. When the Central Bank of Hungary added gold, I want to say 2 or 3 years ago, they put out a press release that specifically said that in periods of change in the international monetary system, gold has performed well and therefore is a hedge against potential downside risk during that time. And that was the rationale they gave for that purchase of gold then. Whether it's appropriate to use the term regime change, I think is a little bit associated with, certain countries deploying military forces to topple other countries' political structures. Maybe not my choice of words, but certainly evolution in the international monetary system is something that we should talk about more. And the introduction of CBDCs might have an impact on that. But ultimately, as our research has shown, gold does provide some protection during that type of change.
Yes, well, thank you. And I'll ask Marius to comment on that in a moment. I will simply give the final answers to the poll. The amount of people who think that there will be an increase in the interactions between these two communities has gone up slightly. It's now 70%. 20% feel it'll stay the same, and 10% will be reduced. So that's the final result of our little poll here. Marius, regime change is, I think, perhaps not the right word. If you think of a country like Lithuania, where the Germans and then the Soviets and then the Germans again swept across the land only in relatively recent history, and luckily nobody is thinking of doing that in the next few years. But what is the word that we should use to describe the present state of flux in world money, Marius?
I'm not allergic to this word, regime change. And it immediately triggers to me, kind of data analysis type of thinking about that, and the relationships that we rely on in our debate, is gold a good hedge or not a good hedge based on the data that we have observed. And any regime change in time series means that the data that you rely upon to draw your structural implications about is now different one. So you need to update the priors, or go deeper to understand the logic behind the prices, the activity of people that you are now analyzing. So to me, I think a regime change is a good one. Are we on the edge of potential regime change? Yes. The way people interact with each other, the notion of community, it's not any more local. The way we work becomes, we work and we have interaction right now across the help of the internet, right? And people engage in economic activity in now a completely new sense. Not only children and even adults are joining in multi-million communities where they exchange digital artifacts, and they need a settlement asset for that. Is that a regime change? Yes, it's a regime change. It's a digital economy.
Well, yes, and of course the COVID pandemic has accelerated this, and of course it is remarkable to think that this once in 100 years experience has happened just at the time when the technology has been sufficiently advanced to allow this kind of interaction. Because even if this had afflicted the world, say 5 years ago, we wouldn't have been able to ramp up these kind of video calls. This brings me to the final remarks. Actually, I will wrap up our session here on the CBDCs and the gold market. As I said at the beginning, we thought we would apply ourselves and come up with a rather open-ended and perhaps rather novel question right at the end of this session now, which has been going on for about 5 hours, our conference today. So I'd like to thank you very much, Shakai and Marius, for being part of this. And I'd like to simply address a few closing remarks. I do hope, of course, that we won't have to rely so much in the future on these video calls. They are very good, as Marius says, because you can interact with people. You'll be sitting talking to people in Korea 1 minute, and then you're switching over to San Francisco the next. And it's very good to have so many people, as we've had now, on the call, scores of central banks, as well as private practitioners. It's extremely good to do that, but of course you do miss going out and then having a cup of coffee or a glass of beer with each other afterwards. So I do hope we'll get back to that. We will obviously keep up this video interactivity. I would simply like to say a big thank you to everybody who's been part of the conference today. We kicked off with a fantastic opening spell with Paul Tucker and John Orchard. We then went into the issue about retail CBDC and the European Monetary Union. Obviously, we touched upon that as well with Marius just now. Went very much into the wholesale CBDC and the interaction with the capital market. So that's another very important point. Then we ventured out somewhat more widely in the third panel into the whole question of digital assets and these regulatory questions. How do you treat digital assets from a point of view of the current and future regulatory infrastructure, both in the United States and in Asia and Europe? That's another one of these pieces of unfinished business. And I think in this final session, we've simply explored, without being able to answer any of these great questions, we've explored whether or not CBDCs will either be part of or contribute to, or possibly even help some sort of beneficial regime change or change in the international monetary system. And of course, one uses the word system advisedly because there isn't actually a system. I would say that ever since Bretton Woods collapsed, ever since 1971, ever since the dollar gold convertibility was, quote, suspended, end quotes, by President Nixon in August 1971, there hasn't been a system. But we are seeing flux in the way international money works. And I think the gold market is simply a reflection of that. We know we hold no particular argument for gold. We simply see gold as one of the attributes and one of the symptoms and one of the residues, if you like, of changes in the overall monetary sphere. So I would like to thank everybody on the team at OMFIF for putting this together. I really do think that our DMI partners that we've now been with you now over the last year and a half, and you made an enormous difference. G&D Technology, Visa, SDX, Algorand, BNY Mellon, and SICPA today have been there very much with their support. But there's so many others of you who have been contributing, and I think will continue to contribute. Next week in the Digital Monetary Institute, we'll be releasing a joint OMFIF and Giesing and Devrient G&D survey on consumer attitudes to CBDC. And this survey extends into some interesting countries, quite wide-ranging, the US, Germany, Indonesia, and Nigeria. So we can really see the balance between the advanced countries and those which in some ways are proceeding far more quickly, much more rapidly in terms of digitalization of payments. And there you see that particularly in the African world, but you also see it in Indonesia as well. So that's going to be very interesting. And I mentioned already surveys that we've done in the past, which are all on our website. Some of them are referenced in the CBDC report that has just come out today, which we've done along with our friends from the World Gold Council. And then on the 14th of December, we have a panel and a report launch on the future of cross-border payments, where we bring in the whole panoply of payments well beyond the issue of digitalization. As has been said in the panel just now, there's some extremely good and efficient payment systems which are being upgraded all the time in countries like the United States or Germany or the United Kingdom. Maybe it's somewhat more advanced in Europe than it is in the United States. So there's a question in those jurisdictions, do you need a digital currency when the present payments infrastructure, and this is certainly the case in Europe, is already very much fit for purpose. And we're going to be talking about digital currencies in cross-border payments, but also the issues of DLT and the whole question of international coordination, which really does play a big role in all that we're doing. I'd also like to put in a view that in the established working parties that there are, the BIS working party and so on, I think there should be room for the emerging market economies to be part of this, just as in the world of the greening of the financial system. We now have the NGFS, the Network for the Greening of the Financial System, now has 100 members or more, having started off with just 8. That includes many developing countries. I do believe that the cross-border groups that have been set up by the BIS, with mostly the European and North American central banks involved, I think they should be extended. Maybe they are being extended as well to the developing world. And I know the BIS has got a hub in Hong Kong, which is very much looking at all that. I would have thought that somewhere China and Russia need to be involved in all this as well, since they do have fast developing plans for their own CBDC systems. And whether there's political will or not at a higher level, I think maybe at a technical level, it would be good to involve those countries as well in those interactions. So you've had a very long spell, those of you who've stayed with us right until the very end. Thank you very much for your patience. I do hope you've learned a lot. We'll be sending out some notes about all this, what we think we've learned from the last 5 hours and what we think we're going to be doing in the future. So this is me, David Marsh from OMFIF, saying over and out from the OMFIF European Digital Payments Conference, and wishing you well and hoping you'll join with us next time round. So thank you all very much for being with us, and goodbye, good night to all of you. Thank you very much for being with us. All the best. Goodbye.